Hi everyone. Today I want to talk about a very interesting story about US stock market. The Fed has new boss, Kevin Warsh. Does this mean your stocks are in trouble? Most people are talking about Trump, but the real question is about his policy. Should you sell or hold? Let's look at what history tells us how we can keep our assets safe. Before we start, every morning I post very important stock market news at stock open time. So please check it out. It will be very useful and helpful for your investment. Kevin Warsh is now officially set to take over from Jerome Powell and lead the US Central Bank, the Federal Reserve. But if we only look at this as Trump put his own guy in charge of the Fed, we miss the bigger point. The real question is this: what kind of policy will Kevin Walsh bring into Fed? And how could that policy affect AI stocks, big tech, the bond market, the US dollar, and the entire American economy? If you watch today's video, you will get the answer. Most people may think like this. Trump wants lower interest rate. Kevin Walsh was picked by Trump, so rate cuts are coming, and that should be good for the stock market. But the view is too simple because Kevin Walsh is not just a cut rates type of person. Kevin Warsh has been saying for years that the Fed put too much money into the market and bought too many bonds. And because of that, asset prices went too high. Stocks went up, real estate went up, bonds went up. People who already owned assets became much richer, but people without many assets had to deal with inflation and a higher cost of living. Walsh says this is an unhealthy system. And this is where the story gets interesting. Trump wants lower rates, but the US government interest burden has become too big. America has a massive national debt, and every year the government has to spend more money just to pay interest on that debt. So even a small drop in rates could reduce a huge amount of pressure on the federal budget. For Trump, cutting rates is not just about helping the stock market. It is closer to survival tool for the US budget. But Walsh is not someone who simply wants to float the market with more money. He may support lower rates, but at the same time, he may want to shrink the Fed balance sheet. This is the heart of the story. The Fed has two big tools. The first tool is interest rates. Everyone knows this one. When the Fed cuts rates, borrowing money becomes easier. That usually helps the economy and can support the stock market. The second tool is the Fed balance sheet. This may sound difficult, but it is simple. It means how many bonds the Fed owns. When the Fed buys bonds, more money flows into the market. This is called quantitative easing, or shortly saying QE. When the Fed owns fewer bonds, money leaves the market. This is called quantitative tightening, or QT. Usually, these two tools move in the same direction. When the Fed wants to help the economy, it cuts the rate and adds money to the system. When the Fed wants to fight inflation, it raises rates and takes money out of the market. That is the normal playbook. But under Kevin Walsh, the market is worried that these two tools could move in opposite direction. On one side, the Fed could cut short-term rates. On the other side, the Fed could keep reducing the bond its own. So what does that mean? It is like driving a car with one foot on the gas and one foot on the brake. Lower short-term rates can help the economy and the government budget. But if the Fed keeps reducing its bond book, there may be less money in the market. And that can be a problem for the stock market, especially expensive growth stocks. So why AI matters? This is where AI becomes very important. People who think like Walsh may see it this way. If AI makes companies more productive, it can help bring inflation down. Companies can do more work with less cost. If costs go down, prices may not rise as much. That means the Fed could cut rates without bringing inflation back in a big way. That is the positive case. In simple words, AI could act like a shield against inflation. So the big question for this new Fed era is this: can AI actually make the economy more productive? Or is AI still too expensive with stock prices already too high? If AI truly creates a productivity wave, the Kevin Warsh Fed could work. Rates could come down. The economy could stay strong. Inflation could stay under control. And AI infrastructure companies could keep growing. In that case, companies like Nvidia, TSMC, Broadcom, Micron, cloud companies, and data center companies could continue to lead the market. Okay, so the other side, but there is another side too. AI sales may not grow as fast as investors expect. Companies may keep spending huge amounts of money on AI, but profits may take longer to show up. At the same time, if the Fed keeps reducing the bond it owns, there may be less money in the market. Then expensive AI stocks could face a big correction. And companies with only an AI story but no real sales or profits could be the first ones to fall. Let's look at the 2019 market shock. There is one important example we need to remember. The short term funding shock in September 2019, do you guys remember? At that time, the Fed started cutting interest rates, but it was still reducing the bonds it owned. So, on the rate side, the Fed was giving the market an easier signal. But on the money side, it was still taking money out of the market. As a result, stress appeared in the short term funding market. Short term borrowing rates suddenly jumped. The New York Fed had to step in and add emergency money to the market. In the end, the Fed had no choice but to stop reducing its bond book. This event matters because the market may see a similar experiment again. But this time, there are more risks than 2019. US government debt is much bigger. Inflation has not fully disappeared. Energy price is very high. AI stocks already have very, very high expectations, and the political tension between Trump and the Fed is much stronger. That is why it could be dangerous to see Kevin Warsh's confirmation as only good news for rate cuts. The real thing to watch is not just rates, it is money in the market, and it is actually AI sales. Going forward, investors should watch three things. The first, big tech AI sales. We need to see how much money companies like Microsoft, Google, Amazon, and Meta are actually making from AI. If AI sales keep growing fast, the market can stay strong. But if that growth starts to slow, it could become a warning sign for AI stocks. Second, the bonds the Fed owns. We need to watch how fast the Fed reduces its bond book. If the Fed cuts it too quickly, there may not be enough money in the market. Third, short term funding rates, especially SOFR and the repo market. SOFR is usually calm, but if it suddenly jumps, it can be a sign that stress is building somewhere inside the financial system. Kevin Warsh becoming Fed chair is not just a leadership change. It may be a sign that the US economy is entering a new experiment. Trump wants lower interest rate because the government needs to reduce its interest cost. Walsh may want to reduce the extra money created by the Fed, and the market is hoping that AI can carry the economy through all of this. If AI really creates a productivity boom, the market could enter a new uptrend. But if AI profits come slower than expected and money leaves the market at the same time, the market could face a sharp reset. So the key question is not just will rates go down? It is not that simple anymore. The key is three things: rate, money in the market, AI sales. If all three moves in a positive direction, the market can keep going. But if one of them breaks, especially for expensive AI stocks, risk can rise very fast. Right now, the market is testing the new Fed chair, and at the same time, it is testing whether AI can truly change the economy or not. This is not just a political story, this is about US debt, Fed independence, the AI bubble debate, and global asset markets. As investors, we should not only watch headlines, we need to understand what is happening behind the headline. Do not get excited just because rate cuts may come. Watch whether money is leaving the market. Do not trust the AI story alone. Watch whether the actual sales are showing up. In the end, the key question is, can Kevin Warsh's Fed create a new productivity boom in the AI era or not? Or will it bring back a market shock like 2019? The next few months could be very important. Thanks for watching my video today. I'll bring more interesting and important market news and insight again. Please hit the like and subscribe to the channel and do not miss the new market insight. Thank you.